Well, folks, we got to talk about PPI. We got the number this morning, and it was hotter than expected. What does that mean for going into 2023? Stagflation or recession, two economic phenomenon that can have significant impacts on a country's economy. And while they may seem similar at first glance, there are important differences between the two. All right, folks, take a look at this headline right here. Wholesale prices rose 0.3 in November, more than expected, despite hopes that inflation was cooling. The Producer Price Index, a measure of what companies get their products in the pipeline, increased 0.3% for the month and 7.4% from a year ago. A 38% surge in wholesale vegetable prices helped push the food index up by 3.3, offsetting an identical 3.3 decline in energy costs. Markets will now turn their attention to the more closely watched Consumer Price Index, which is due out Tuesday morning. Wholesale prices rose more than expected in November as food prices surged, dampening hopes that inflation could be headed lower, the Labor Department reported this morning. The Producer Price Index, a measure of what companies get their products in the pipeline, increased 0.3% for the month and 7.4% from a year ago, which was the slowest 12-month pace since May 2021. Economists surveyed by Dow Jones had been looking for a 0.2% gain. Excluding food and energy, core PPI was up 0.4%, also against a 0.2% estimate, so double what the estimate was. Core PPI was up 6.2% from a year ago, compared with 6.6% in October. And you can see the chart here, year-over-year percentage change in the PPI. Yeah, I mean, it's peaked, and it's obviously starting to come down, but still hotter than expected this morning, 7.4%. And obviously that put pressure on the markets this morning. Stocks fell following the report after previously indicating a positive open on Wall Street. Treasury yields moved higher. Markets will now turn their attention to obviously CPI that we get on Tuesday morning, and then the Fed Reserve will conclude a two-day meeting with an announcement on where interest rates are heading. So does this PPI, hotter than expected data, does that allow the Fed to still go 0.5, or are they going to go 75 again? Does this make them nervous? Are we heading towards stagflation? For those of you who don't know stagflation, that is a unique economic phenomenon that occurs when an economy experiences stagnant growth and higher inflation at the same time, and some say that's where we're heading. This situation is characterized by low economic output, high unemployment rates, and rising prices. Now, again, you get a hot rate like this morning, and people look and they go, well, we thought this stuff was coming down. We thought inflation had peaked. It was still coming down. But now you have PPI comes in much hotter this morning. Now the Fed, what do? Do they go 50 basis points instead of 75? Does CPI come out hot on Tuesday? Does that change what they do right after? They're meeting literally right after the CPI data comes out. A lot of people say if it's not a recession, we could be headed towards stagflation. Now, stagflation can be caused by a number of different factors. And of course, one of the most common causes is the increase in the cost of production, which can be caused by a variety of things, including an increase in the price of raw materials or an increase in the cost of labor. And we're seeing both of those things. Another common cause of stagflation is a decrease in the demand for goods and services. Now, we haven't really seen that yet. Services is still very hot. People still have some money to spend, but if you look, you see credit card usage going up, you see savings coming down. So if you get a reduced demand in goods and services, that can be caused by a variety of things, including a decrease in consumer spending, which some of the charts start to show that maybe that's what's coming. As bank accounts start to plummet, credit card usage starts to go up, or obviously a decrease in investment by businesses. And of course, businesses are going to do that as they're heading into a year where they think maybe there could be a recession, maybe there could be stagflation. Obviously, cash has been king really this whole entire year, so businesses spend less. You think about the 1970s, probably one of the more notable stagflation eras in the United States. At the time, the U.S. economy was experiencing a period of slow growth, which is some say that's what we're heading into in 2023, high unemployment. Now, the Fed would like to see unemployment tick up, but can they engineer a soft landing without getting to high unemployment is still yet to be seen. Rising prices, well, We're not exactly seeing that yet either. So maybe stagflation is not on the menu. Some people say we have to be on the lookout for it. Some people say maybe it's a recession, but maybe it's a shallow recession, not the recessions that we're used to. Some say the 2 negative quarters we had earlier this year was a slight recession. So the situation is caused by a number of different factors, obviously, including an increase in the cost of production, a decrease in demand for goods and services. The effects of stagflation can be quite damaging to the economy, so we want to try to avoid it if we can. For one thing, it can lead to increased poverty. It can lead to inequality as high prices make it difficult for people to afford the goods and services they need to maintain a decent standard of living. Additionally, stagflation can lead to decreased investment and innovation as businesses are less likely to invest in new projects when the economy is not growing. So how do we combat stagflation? Well, we're relying on government and central banks often to use a combination of monetary and fiscal policies, which is what we're seeing now as they try to reduce inflation. The problem is monetary policy from the Fed and fiscal policy from this Joe Biden administration, this government, never works hand in hand. They work against each other. Biden wants to spend. Democrats want to spend. Deficit spending, deficit spending, deficit spending. Meanwhile, the Fed's trying to rein in inflation, reduce the balance sheet, bring the M2 money supply into check. It's blown up the last 2 years. We've printed 40% of all dollars in existence the last 2 years. So monetary policies such as lowering interest rates can help to stimulate demand, encourage economic growth, but we're not even done raising rates. The Fed has raised rates this year more than anyone ever thought, fastest pace in the history of the country. So they're not going to be looking to cut rates. The Fed's looking to leave rates at a terminal rate of probably 5, maybe even 5.25. Most people think they're going to raise 50 basis points in December, 25 in January, maybe another 25 in February. That's another 100 basis points from where we are now. That puts us at a terminal rate of about 5.5, 5.75. And most people think they're going to have to leave that rate there for all of 2023 before they even think about using monetary policy to slash rates, to cut rates. So we'll see what happens. Now, obviously, if we were to get into a deep recession or stagflation got really bad, obviously the Fed would have to look to start to cut rates again, but it's not what they want to do, given that they're not even at the terminal rate yet. Fiscal policies such as increasing government spending or reducing taxes can also help, but does anybody sit here and think that we're going to get a reduction in taxes to stimulate the demand and boost economic activity? No, the Biden administration wants to raise taxes. You mix. I've said this before. You mix bad tax policy with stagflation and recessions. That's what points you towards depression. So we all hope, obviously, we can avoid that. We really would like to avoid recession. Obviously, any kind of period of economic downturn in which there's a decrease in overall economic activity obviously is not great. Obviously, this is typically characterized by a decline in our GDP, which we'll be keeping an eye out. Usually it's 2 quarters in a row is considered a recession. A decrease in employment, so the unemployment rate goes up. Obviously, a drop in stock markets, risk on assets do not do well, obviously, in any of these times. So while there may be some inflation during a recession, it's typically much lower than during stagflation. So some say stagflation is actually worse than what would be a narrow recession, where we don't bring the economy to a standstill, which is what we want to try to avoid. And obviously the differences between stagflation and recession is the cause of the economic downturn. Stagflation is often caused by a combination of factors, including high demand for goods and services, supply bottlenecks, which we've seen for now going on a year and a half, and a decrease in the supply of money, which the Fed is trying to do now because we've expanded the balance sheet from $4 trillion to $9 trillion. Now they're trying to unload that balance sheet and bring the M2 money supply back into some kind of check. In contrast, a recession is typically caused by a decline in demand for goods and services, leading to a decrease in production and employment. Another key difference is the impact on the economy. During stagflation, prices continue to rise, even as employment falls, leading to a decrease in purchasing power for you, the consumer. This can lead to a decrease in demand for goods and services, further exacerbating the problem. And of course, we've talked about other things that exacerbate the problem, like rent and how that's factored into the CPI. Mortgage rates now around 7%, forcing people who wanted to buy a house, look at a house. They can't buy a house and look at a house. That forces them into renting. Renting continues to go up, continues to feed the CPI number. CPI continues to be hot. So it's like a self-fulfilling prophecy. So that's the problem. During a recession, prices may remain stable or even decrease, providing some relief for consumers who may be struggling with high unemployment. So PPI this morning, hotter than we wanted. Double 0.2 was the expectation. 0.4 is what we got. We'll see what we get for CPI on Tuesday, but keep these two terms in mind, stagflation and recession. Neither is good. Some say stagflation could be worse, and it could be drawn out over a long period of time. So we want to try to avoid that if possible. We'll see what the Fed does this month. We'll see what they do next month. Let's see what the terminal rate is. But PPI this morning, not a good rate. And again, we'll keep an eye on CPI that comes out next Tuesday. All right, folks, as always, support our sponsors. Mike Lindell, MyPillow. Use our code LFS6B at checkout for 10 to 60% off all your holiday shopping over at mypillow.com/LFS6B. And I'll see you in the next one.